Hi everyone, let's go over my bullish and bearish Elliott Wave scenarios on Bitcoin, starting on the medium time frame with the bearish but eventually bullish scenario, as we're going to be working on a wave 4 in green before then a wave 5 to the upside, hitting that 50k area, maybe even going above for a little bit of a fake out and then get a bigger retracement to the downside. In this scenario, the target area for this green wave 4 is between the 236 and the 05, taken from the low of 2 to the high over here, giving you a target area between 40.3k and 35.3k. The invalidation for this green wave 4 would be for price to move to the downside and hit the 0.618 at 33.1k, as then we can expect either a much longer range, but not a wave 4 anymore, or much lower prices to come. In this scenario, we are then still looking for a move to the upside. Of course, 50k is already mentioned, but we do have some resistance above price. The golden box here, 45.2, 46k, 47.2, 47k. Then we have 48.8, 49k, and then eventually 50.7 to 50.9k. In the more bearish scenario, we're already finished with 5 waves to the upside. The impulse is in, and we are already looking for a bigger corrective structure to the downside, where this weekly gap is going to play an important role. If I go to the weekly time frame, then you can see over here that on the weekly time frame we had a candle high, a candle low, and this is the candle that created a gap. Now usually the high of a gap will at least act as a little bit of support for then a bounce towards the upside, but if price is going to close high time frame like daily candles inside the gap, probabilities increase to fill that gap towards the downside and move to 30.3k. If we then look at the bullish scenario, then in the bullish scenario, we are still looking for a final push to the upside in a wave 5. Wave 4 is in, and we are looking here for a 1, 2, 3, 4, 5, one more push before then a move towards the downside. And that one more push would then look something like this, because we are looking for an impulse to the upside on the lower time frames, where then we have a wave 1 and 2 finished, 3 also finished, 4 preferably already in, and then we're looking for a wave 5 towards the upside. The reason that wave 4 is preferably already in is also because of time. At the moment, you can see that this range over here is 3 times longer in time than wave 2 because of the vertical line on the chart. This is a fib time taken from the high of 1 to the low of 2, put on the high over here, which compares the length in time of wave 2 with the length in time of wave 4. And you can have a flat structure here in this wave 4, but if it's going to continue, we're going to get a much longer WXY or more complex correction, but going past the 3 is not too common for a wave of 4. Now also, if we are looking for this to be the end, however, of a wave 4 and impulsive continuation to the upside, there's basically 2 scenarios here on the lower time frame that could work and we have to think about, but they're not pretty. So the first one here would be a double 1-2. 1-2 in yellow, looking for a bigger 3 in yellow to the upside as well. And then inside wave 3, we have a sub-degree count in blue, which is then a 1, 2, 3, 4, 5. Now in this scenario, the second wave 1 of a lower degree, which is the blue wave 1, is longer in price than the higher degree wave 1, which is the yellow wave 1, which can be seen by price passing this 1-to-1 taken from the low to the high of 1 to the low of wave 2. But also, if we're still working on this being a wave 2 retracement as well, because so far this move to the upside looks 3 wavy, then also this wave 2 is longer in time than the yellow wave 2. This is again a fib time taken from the high of 1, low of 2 to the second high over here, comparing wave 2 of a higher degree in yellow with wave 2 of a lower degree, which is the blue one. Preferably, the wave 2 of a lower degree is shorter in time and price than the wave 2 of a higher degree, but that is not the case over here. So that gives lower probabilities to that scenario, where then we can also be looking for a diagonal, but it's very, very early to start thinking about diagonal still, because then you only have a wave 1 finished and maybe wave 2 also already finished, and you're now working on a wave 3, which then has to be a double zigzag structure to the upside, which is possible in an ending diagonal because you want all of the waves to be a zigzag structure or double, triple zigzags. In this scenario, you then have your zigzag 1 here and then a W, you have your zigzag 2 and then a wave X, and then you're going to be looking for another 3-wave zigzag structure to the upside in your wave Y, which then finishes your wave 3 in a double zigzag, after which we then expect a wave 4 and eventually a wave 5 to the upside. This is currently the more preferred bullish scenario between the two on the lower time frame over here. If you look at the bearish scenario, then the bearish scenario is this impulse towards the downside. So here we're looking for a 1, 2, 3, 4, 5 finishing 1 or A. Then we're looking for a 2 or B and a continuation to the downside in a wave C or a wave 3. Currently, price is ranging around the golden pocket, which is a common area for both 2 as well as for B. 786 area is the same, common for 2 or B. But if price is moving to the 886, probabilities will increase to take the high, because the 886 is a rare target for 2, but a common target for B. Any move to the downside, higher probability it's a wave C or a wave Y, which then means returning back to the upside later. Now also, if price hits the 886, it's very common for price to retest the golden pocket, move to the downside, retest the golden pocket, and then continue towards the upside. So that is something that I'll be looking for as well. If we then zoom into this structure over here and look at the bearish scenario, then we're looking for an impulse to the downside. To the upside, we then count a wave A, B, C, a 3-wave structure to the upside, followed then by a potential 1, 2, looking for a bigger 3 towards the downside. Now, in this particular scenario, wave 2 did retrace to the 886, and that is actually not really what we want to see. Of course, it's with a wick over here, candles closing below the 786, which is good. The problem is, the moment the 886 is touched, any move to the downside has a higher probability of being C or Y, increasing probabilities to move back towards the upside. Also, if we're looking here for a flat structure or a WXY, where X went below wave W, it's a very deep one as well. The 1.618 over here was hit, which is a less common target for B or X, but look at the wick to the downside as well. Now, wicks tend to get filled, doesn't have to be immediately, but it is a wick that at least we have to keep in mind for the near future. If we look at the CVD divergences, then the bullish CVD divergences here played out as the high was taken. Then locally here we had some bearish CVDs building, which lower high on price, higher high on the CVD gave pressure to the downside. Big move down as well, quick move. Price moving back up, again started ranging, but again overnight here, bearish CVDs building also played out as this low got taken. Now with the wick, we have these bullish CVD divergences, which I'll show in a second. Higher low in price, lower low on the CVD. However, CVDs with a wick candle do have a lower probability of playing out based on statistics. So that is something to at least remember. What I prefer to see is more local strength over here, like make a new low, create some moves up, retracement down like this. And then new bullish CVD divergences instead of with the wick that we have over here. But here you can see what I mean. So we have lower high in price, higher high in yellow, lower high in price, higher high in yellow, bearish CVD divergences. And then here we now have higher low in price, lower low on yellow. You can see the yellow line is below these lows here, as well as a lower low on blue. That is a bullish CVD divergence here, but it is with the wick. And if we then look at the probabilities of the different scenarios, then on the medium time frame, still looking for another high at the moment, which over here has 2 reasons. On my chart over here, we have a truncated fifth. Now, I do realize my chart has a wick and many others do not, but I still don't like a truncated fifth over here. Also, we actually finished these highs just below important resistance areas. Didn't really have any crazy resistance over here. But also the final leg towards the upside looks quite corrective, which is this leg that we have over here, which I covered in a previous video, which is very, very, very difficult to count as an impulsive structure. And because the probabilities are higher, this is a corrective structure, and increases the probabilities that all of this is corrective price action, and we still eventually have some more upside to go. Now on the low time frame, which is the more local price action here, the 886 is hit here at the highs, right? In the bearish scenario here locally, the 886 is touched, and also we don't have bearish CVD divergences with these highs. Lower high on price, higher high on the CVD. If you go for a big turnaround, a big pivot, big move back towards the downside, then preferably I want to see bigger bearish CVD divergences. Of course, we have local bearish CVD divergences, which we have to continue to keep an eye on, because if price is going to move towards the downside, maybe fill the wick, but you continue to see bearish CVD divergences with each little retracement, we can be looking for lower prices to come, right? But we don't have bigger bearish CVD divergences with the top over here and the local 886 is hit, which increases probabilities. Any move down is a C or a wave a Y. If we look towards the bearish side, however, we did have some bearish CVDs over here locally, right? As mentioned, the double 1-2 here is not looking great, and a diagonal is really early to call at the moment. So for a diagonal, you really want to see price moving to the upside, and it's just way too early because we are still also below the resistance box that we have over here. Plus, we have a wick towards the downside. They do tend to get filled, so that is something we have to keep our eyes on. So finally here, we got to keep an eye on this target box, specifically the blue one that we have over here, which is sitting between 43.5k and 44k. This one is very important. If price can pass this resistance area here, then I'll be looking for the gold area above. However, if price continues to range in this area, we wait for new information, which then leads to new probabilities, and keep a close eye on the CVD divergences that are building in this range as well, for then changing probabilities on the higher time frame. So I hope this video was helpful or valuable to you. Please check out the most recent educational video I've made about the best trading indicator you can use in my opinion, which is the CVD. And for now, thanks for watching and subscribing, and I'd like to see you at the next one. Bye bye.